Welcome to the Farming Without the Bank podcast, the show with a no BS approach to money, hosted by a farm strategy expert and authorized IBC practitioner. Join us as we get real and expose the flaws of traditional financial institutions in order to help farmers take control of their finances, create peace of mind, grow their wealth, and leave a legacy. Now, here's your host, Mary Jo Irmen.
Hello and welcome to today's podcast. Thank you for tuning in. I very much appreciate that. Today, let's just get down to it. We're going to talk about if taking loans on a life insurance policy makes you money. Oh, this is so confusing to people. And I understand how they can get confused. But I might get on a little soapbox here today because this is really one thing that some agents that teach the whole life insurance policy or some clients who use it make it sound like it's this get-rich-quick thing and that we are creating money out of thin air. Now, if you listened to the podcast right before this, you heard me talk about fractional reserve banking and how bad that is and why we're not creating money out of thin air. So we don't want to be misunderstood and have people believe that we are creating money out of thin air here. We are not doing that. And a lot of people misunderstand Nelson's book. And if you've read Becoming Your Own Banker, you will see that Nelson demonstrates taking loans and paying these loans back at a higher interest rate and cash value is growing, okay? That is an illustration to get you to understand the concept of why you want to pay yourself back more interest than what's being charged, why you want to be an honest banker, okay? So there's a couple of things we need to understand. You do not make money taking loans. You make money paying premium. When you pay premium, that money goes to cash. Some of that money goes to cash value. Some of that money goes to death benefit. When I structure a policy, in most cases, 75% of the premium goes to cash value. So we have access to borrow against that in anywhere between 7 to 10 days, 30 days, depending on the company that I use. Okay? In Nelson's book and in my book, I talk about being an honest banker. So let's say that the life insurance company is charging you 5% to borrow their money. If you are honest and you pay it back at 7 or 10 or 20, I don't really care what it is, but let's just say that you had a land loan at 7%. If you're going to borrow money from the policy at 5, why would you not be honest and pay yourself back at 7? Because you were willing to pay the bank 7%, right? The other 2% does not go in the policy as a loan repayment. It goes in as a premium payment. Because if we borrow $10,000, we can only put $10,000 back. Any extra interest is going to go into that policy as a premium payment because we can't fit it in as a loan repayment because we've paid ourselves back. That in turn goes to cash value. The extra 2% is going to go to cash value, and it is going to increase your cash value. Absolutely. So it looks like we're making money because we're putting more there. Now, where this gets a little, and we are making more money because we put more there, which then increases the amount of interest that we're earning and the return of dividend that we're getting. That's all generated by how much cash value we have. So yes, we are making more, but I want you to understand the first 5% that the insurance company charged you went to the insurance company. You don't get to keep that. That is why you get paid a dividend, because your company, aka your bank, guess what? They made income because you borrowed from them instead of the bank down the street. Again, if you've not listened to my last podcast on the Federal Reserve, you're going to want to do that to understand where Nelson was coming from when he created this concept and his thought process behind it. But let's be very clear. People think that they're going to get all 7%. You're not going to get 7% unless you pay 7% over the 5% that they're charging you. The life insurance company has to stay in business. Your bank needs to stay in business. They need to take that to pay their employees, to pay for their software, to pay for the actuaries, to pay for the paper, the computers, the building that they're in, right? They need to make sure that they have enough money to keep your business in float and keep the doors open. So if you're getting a dividend, some of that interest that you paid in, some of it may come back in the form of a dividend, but anything extra that you pay to yourself is going to go into your policy as a premium payment. Now, those of you who are clients, or I've talked to, or you've read a lot about it in Nelson's book, he talks about the modified endowment contract, and I call it the MEC line. MEC, Modified Endowment Contract. So the government came in the 80s and said, hey, whoa, all you millionaires, you're sticking money into these life insurance policies, you're putting money in one time, and you're creating all this cash value growth that's income tax free. We can't do that anymore. We're going to stop you. If the growth of your policy and your cash value gets too close to death benefit, and you cross that line, we're going to make everything in that policy grow taxable. So we don't want to cross that line. We set these policies up so that it does not cross the MEC line. So everything grows income tax free. And when we borrow to use it, it's income tax free. So what happens if I set a policy, the MEC line, at $10,000 a year? And you've already put your $10,000 of premium in. That's your MEC line. Well, now you might want to pay yourself back an extra $1,000 of interest because you charged yourself extra interest. What do we do with it? Well, you can't put it in the policy because it might cross that MEC line. So we're going to start another policy with it if it's enough. Or we're going to put it in a savings account until we can start another policy with it. Nelson had 49 life insurance policies because he didn't want to cross the MEC line on any of them. So when we are looking at an illustration in Nelson's book and he's continuing to put it all in one policy, again, it is for illustration purposes. You have to make sure you read the part of his book and the part of my book that talks about using your imagination, reason, and logic. And that is in the very beginning of Nelson's book. He puts that in there for a reason. We need to use our imagination, reason, and logic. Reason being, I can't put it in because it's going to MEC. What do? I start another policy when I have enough to do so. Does that or should that stop you from paying extra interest to yourself? No. If you have credit card debt at 18 to 30% interest, and you were willing to pay the credit card company that, why not pay yourself that? So if we're borrowing that same $10,000 from the policy, if we're going to borrow against cash value and pay off that credit card at 20%, make sure you pay yourself back that 20%. Why wouldn't you? Basically forced savings. And it's a forced savings that you can amortize however you want. But it's there, and you're being honest. You were going to pay that to somebody else. If you put that extra 20% of interest inside the policy, you can turn around and borrow against it right away. You didn't lose access to it. We just transferred it to this savings account, right? Cash value is not a savings account, but it acts like a savings account. So if you are taking loans and paying back the loan, do not think that you are getting the interest the insurance company is charging you. You might get a tiny bit of that back in the form of a dividend because the insurance company made some money. You're the owner of the insurance company. You're the part owner of the insurance company because it's a mutual company, which means you and I now own part of this company together. And so when our insurance company lends money to the policy owners and they make income, we get a share of that income. It's a good thing. It is not a bad thing to be borrowing money from your company. Now, you've also heard me say sometimes it doesn't pay to do that if we have a lower interest rate at the bank. Maybe it doesn't. It kind of goes back to what my last podcast was about. Do we want to participate in fractional reserve banking or do we not care? That is up to you to decide. I'm not pushing one way or another. I am here to give you the facts and let you make that decision. Sometimes it doesn't matter if the life insurance company is charging 8% interest if I get to have control of my loan. And I'm just going to bring this up right here. I might end up doing it on another podcast, but I'm going to bring it up right here. People always say, well, is that interest rate locked? Is that interest rate going to go up? If it went to 20%, would you rather borrow money from your life insurance policy at 20% than the bank at 20%? Let's just say that they were even. Would you rather borrow money from your policy where you own that loan, you control that loan, you can pay it back whenever you want? Or would you rather borrow it from the bank where they have your livelihood as collateral and you're on their terms? It is not about interest rate. It's about liquidity control and guarantees. And so don't worry so much about what they're charging you to borrow their money. It's not the most important thing. It's important, but it's not the most important thing. Just understand how those loans work. And that when you're reading stuff and you're talking to other agents, you know that you are not getting that full amount of money back when you take that loan. So we want to go to our policy for a loan because we want our bank, our life insurance company, to make money. We want them to be profitable so they can keep the doors open. I mean, it would be like owning the grocery store and saying, you know what? I'm going to go to Walmart. Their peas are cheaper over there than what I sell them at my store or even what I can get them for. So I'm going to go to Walmart. Okay? Maybe if you own the grocery store, you might go to Walmart a couple of times because it's convenient. But are you always going to go to Walmart to get your groceries? Or are you going to buy from your own store and pay the asking price of what's on the shelf? Or are you going to steal the peas? Those of you that have read Nelson's book understand what stealing the peas means. So let's look at that full picture. And again, I just want to be very, very clear. This is not a get-rich-quick scheme. You are not getting all that money back. You have to understand how this works. There are so many people out there. I'm sure you guys are listening to this and then you go talk to your friends or your family and they're telling you that you're an idiot because that's not how it works. And they think they believe that it's working better than they're led to be told, right? Let's just be honest, for Pete's sakes. This is exactly how it works. We have to look at the big picture here. So if you are talking to people and they are giving you a little bit of pushback and they think that you're crazy, you must ask the question, have they read the books? Have they done the research? Have they listened to the podcasts? Have they listened to the YouTube videos? If they have not, they have no place to even make an assumption that they know what's happening. I don't care if they've had whole life in their life before. Don't care. It's not structured the same. It's most likely not with the same kind of companies. And was it really whole life? Did somebody tell them it was bad at one point, so they just believed what somebody told them? You've done the research. You've listened to everything. You're educating yourself. Keep that in mind when you're talking to these people. And I am here to provide you the information that you need to have to share with them. So when they come back and say, oh yeah, they told me that I was going to get all the money, but I didn't. Right. Because Mary Jo said that's not right either. If somebody is making this sound better than it needs to, why? This is just how it works. And it's working great the way it is. We don't need to make it sound better. We don't need to misunderstand what's going on. So I hope that's answered any questions. If you guys have had questions about how the loan works, another reason of why Nelson had 49 policies, being honest, beating Parkinson's law, that's is all in the book. So if you've not gotten Farming Without the Bank yet, go to farmingwithoutthebank.com, grab your book there. You'll see it all there. I also have it bundled with Nelson's book. So if you want to go to the store, you can click on the store and then you can get it as a bundle with Nelson's book. And those really are two very good books to start with because there's a lot of stuff in Nelson's book that I did not put in my book because I didn't need to rewrite his. Okay. So if you have liked this, please leave me a review. As always, let me know what you want to hear, what you maybe have questions on, what you've heard from people that you're talking to. If we need to do a podcast on just the feedback or rebuttals, I would be happy to do one on that too. Just need to hear what they are. So I have a good idea of what they are, but if you guys have anything, please let me know. You can email me at maryjo@withoutthebank.com, or you can message me on Facebook, which is Farming Without the Bank. You can also find me on LinkedIn or Instagram if you're a big Instagram person. But I thank you for tuning in and hope that you found this valuable. You guys have a fantastic day.
Thanks for listening to the Farming Without the Bank podcast. We hope today's episode has inspired you to take control of your finances in new ways. Don't forget to check out our website, farmingwithoutthebank.com, and engage with us on our Facebook page, Farming Without the Bank. Join us next week as we smash more financial myths and empower you to accomplish your financial goals.